Hello everyone, welcome back. Today I'll be sharing four stocks to buy in November based on current valuation and future growth prospects. Okay, so these are the four stocks here if you don't feel like watching the whole video. And now we'll go on with the first one and I'll explain exactly why I chose these four stocks. Okay, so first off, we'll start with Canadian Solar. As we can see, it's down on the month about 3%, but it has been growing year to date from around $22 a share to now 36, close to $37 a share, up 64%. And I do think that is still an undervalued play based off of the current valuation. So it's a small cap company. Someone call it a penny stock, around $2 billion market cap right now with a P ratio of 8, right? And anything with a P ratio of under, I would say, even say 15 in this market is pretty incredible, right? And we can see earnings per share of $4.25. And if we go down to their earnings, their last quarter, of course, it was hit by the pandemic. They only earned $20 million, but it's still good to know that they are in the green, right, as compared to even some other solar companies, right? So if we compare this P ratio um, with other solar companies, we can see that it is a pretty good value play at the moment, right? So this has a P ratio of 8.7, or if we compare to other companies such as Jinko Solar has a P ratio of 48. Um, Sunrun doesn't even have a P ratio because they have negative earnings, and SolarEdge Technologies has a P ratio of 80, right? So by far, Canadian Solar has the lowest P ratio, right? And in my opinion, highest personal growth. And part of that, I think, is because they just announced last week that they launched their Series 7 modules of up to 665 watts, which means they're pretty much bettering their efficiencies in their solar panels, right? So it's excellent value for commercial and utility scale PV plants, reducing balance of system costs by up to 5.7%, and the levelized cost of electricity, LCOE, by up to 8.9% relative to mainstream 445 watt modules. Okay, so that's pretty impressive, right? And this came out again last week, so they'll be able to take advantage of the profits they earn from that in the coming quarters, right? And so I believe that in order to take advantage of the green energy movement, buying into Canadian solar now, even though it's had a run up of about 64% over the past year, would be a pretty good idea because I can only see it going up from here. And in my opinion, Biden will win presidency. So if this does continue and Biden does win presidency, I could see this run up increase even more, right? So that's why I believe in Canadian solar. And if we look at the next one, this one is a new one for me, but I do believe it is quite the value play. So if we're looking at the price over the past 5 years, it actually got a bit destroyed because of poor management. It was a not a very well managed company prior to it, and so it lost about like 93% market share as compared to like 2016, 2017. But then since then, it has been on quite a rip upwards, and it's up 278% since lows in 2019. Okay, so they have new management and they have very, very, very exciting technologies that will allow them to take advantage of the sort of revitalized investment in space, right? You have Jeff Bezos with his aerospace sort of industry, his little side hustle. You could argue that he's copying Elon Musk with his SpaceX stuff. And then there's also Virgin Galactic, which is trying to make space flight. Well, right now it's just affordable to the more elite population, but of course, it's trying to commercialize space flight. Okay, so Maxar Technologies pretty much provides the inputs and also satellite orbits for these wider companies, and also for it has one of its um, investors is the U.S. Army, which we'll see, right? So right now, I think it is incredibly undervalued. We can see that its P ratio is under 6, which is really, really, really low value. They actually just announced a dividend of 4 cents a share, which is 0.16%. But again, it's good to see, and we can see that the 1 year target estimate is $60.52, which represents a huge upside, more than double from here. Okay. So of course, if we look at even their quarterly earnings, we can see they had a huge earnings in second quarter of 2020, but the third quarter is expected to not go so well. So pretty much Maxar is scheduled to report third quarter 2020 results on November 5th after the closing bell. And it's expected to have recorded lower consolidated revenues on a year-over-year basis due to uncertainties stemming from the pandemic. Um, and so pretty much there's reduced volumes of commercial programs at Maxar's space infrastructure segment and supplier delays, along with an increase in estimated program costs. Okay, so a couple of exciting news right now is has a couple of contracts, one with the U.S. Army and a couple with just independent contractors, but pretty much we can see if we go on here just on their press releases here for first Maxar are selected by US Space Force to develop prototype mission data processing applications, right? And this came out October 29th, right? So very, very new recent news. And when one of your customers is the US Space Force, and then also down here, the US Army, they said somewhere down here in their upcoming conferences. Yeah, so Maxar selected to deliver portable satellite imagery ground systems to U.S. Army, right? When you have those types of customers, you know that it's generally a reputable company and will have most likely recurring revenues in the form of contracts with the U.S. Army, right? And even things like Maxar Technologies report significant growth in subscriptions to its Secure Watch platform, right? Which we can read here. That first of all, Maxar Technologies, as a trusted partner and innovator in Earth intelligence and space infrastructure, today announced that it has surpassed 200 customers using Secure Watch, its cloud-based geospatial subscription service. Contracted revenue for the product has roughly doubled in the past year, right? So this is huge. We're looking at a company with, $2.12 billion market cap, a trailing 12 months P ratio of under 6. And so it has the perfect combination, in my opinion, of growth and relatively low value, right? So it's a turnaround growth play. So I definitely think I'm going to start adding to this position just because I think it is quite misunderstood. And I do think that, with all these press releases that they're announcing with US Army, with their record subscriptions to its cloud-based service, and also approves an improvement of a quarterly dividend, I think that it is poised for growth, especially since that they are also going to have their Worldview Legion satellites, which is comprised of 6 satellites designed and built in-house that will fly sun-synchronous and mid-inclination orbits. And it's on track for the launch of its next-gen Worldview Legion satellites in 2021, right? So it just has very, very exciting news all around, and I believe that this type of tech will pave the way in the future to recurring revenue, okay? And the third stock on the menu here today is H2O Innovation. Right now, it's $140 million market cap, and as you can see here, over 6 months, it's up by over 100%, right? And this company trades on the Toronto Stock Ventures Exchange under HEO. We can see current price of $1.82. Again, market cap of $139 million. And what's good to see for me is we can actually see in second quarter of 2020, they reported positive earnings. And they recently got awarded a contract in Canada for $10 million. And they also won the Water Company of the Year at the 2020 Global Water Awards, right? So, I mean, this is a company that's at the leading edge of, desalination plants, of improvement in water quality. And this is a company that I believe will be very successful in the next 10 to 20 to 30 years, just because when we think about water demand, it's only going to increase as population increases. And also, it's only going to increase as water supply decreases. And this is pretty much a certainty, right? All around the world, aquifers are drying up. There's some sources which you can search up saying that by 2050 we'll actually have very little to no fresh water, and so we'll rely on companies like these that, for example, will be producing desalination plants and water purification plants to increase our amount of freshwater supply around the world, right, to feed this population, right? And although right now they haven't produced consistently positive net income, Consensus from 5 of the Canadian machinery analysts is that H2O Innovation is on the verge of becoming break even. So for a penny stock company, that's pretty huge, right? And I know this, I do understand that this is a very small cap company, but for it to be break even or being expected to break even, is huge news. So they expect the company to post a final loss in 2020 before turning a profit of 2.3 million in 2021, right? So I do believe they are expected for the current year to grow at 9.9% in terms of revenue and 2022 at 3.6, but I think this will be closer to 10, to be honest, next year in terms of revenue, right? So I do think right now that, of course, they're not earning any money. I do think that this is a high value and high growth play for the long-term future, okay? Um, and finally, I mean, I just have to put it in there. I do recommend right now buying Frontline, and that's the final stock. I mean, if we're looking at year to date, it's just been beaten down like crazy, right? Down 56% year to date. It trades under ticker symbol FRO on the New York Stock Exchange. Right now, sitting at $5.60 and pretty basically a penny stock right now. Okay, so we're looking at a trailing 12 months dividend of 35% right now. And if we're going to the Yahoo Finance section, we can see it has an insanely low PE ratio, right? So now analysts are even saying that companies like Frontline are a value play, right? And are a value stock just because it has such a low PE ratio, right? I mean, right now we're sitting at not historically high PE ratios, but if we're looking at the S&P 500, the current PE ratio across the stocks that are in the S&P 500 is around like 25 or 30, right? So having a PE ratio of 2.3 is incredibly cheap, right? Also, they tend to pay out most of their profits in dividends. So again, you're looking at a nice and juicy 36% dividend. And of course, they might decrease their dividend as they're not expected to earn as much because floating storage has unpiled and now it's sort of back to regular business, and actually spot rates for oil tankers are actually quite low. However, I do think that this is a company that's going to recover in the long run, right? Oil is not going anywhere, at least for another 10, 20, maybe even 30 years, right? And this company will stand a chance to profit, right? If we're looking at the earnings, we can see quarter over quarter, first quarter, very nice earnings of 165 million. Second quarter, very nice earnings again of close to 200 million. And again, I do expect them to be earning less in third quarter of 2020 just because, of course, spot rates are decreasing, and floating storage has unloaded to a great degree. However, I do think that tankers will recover. Although they have tank now, they will recover. One, because there's a lot of ships that are being scrapped and not a lot of new ships being built, right? Just because the market is so depressed right now. So in the long run, this will favor the lower supply of tankers will favor the tanker industry just because you'll be able to have less tankers out there and more oil producers competing for spots, right? And of course, especially as oil demand ramps up again, I know again that it's depressed due to the second wave of the Roni. However, again, I do believe that this could be a future turnaround play, and I don't see it going down much more than right now, right, sitting at $5.60 with a 2.3 PE ratio. Okay, and of course, it is expected to lose revenue growth year over year. However, I think a lot of that is already priced into the price of Frontline right now. Okay, so that's all I have for you today. In recap, I recommend Canadian Solar to get on the green energy wave, especially since this is a relatively undervalued company. I recommend Maxar Technologies because a lot of the high flying space stocks, such as Virgin Galactic, um, have taken off, no pun intended. However, this is not, I think, poorly understood by Wall Street right now, so not a lot of attention is directed at Maxar Technologies. I recommend H2 Innovation as a long-term value and growth play, just because I think water will be one of the commodities that will be pretty scarce in the future, and H2 Innovation will be able to take advantage of purifying and refining and providing desalination plants. And finally, Frontline, just because I own Taker stocks. I do believe in the industry for at least the next 10 to 15 years. And I do think they have been hit so hard, they have tanked so hard, pun intended there, that there will be a turnaround in the, I don't know, 2 years from now, maybe even sooner than that. Of course, I'm exposed to the tanker industry through NAT. But anyways, I do believe Frontline is a better play. Okay, so again, I hope you enjoyed this video, and if you did, please be sure to subscribe for more content and like the video, and I'll see you guys next time.